So many stocks are overvalued right now. Yes, there's demand, money's flowing into these stocks, but is it sustainable? I'm gonna let you guys know. Welcome back to the channel, guys. It's me, Adam. You are watching Steady Invest, and I'm really excited to share this video with you guys. It's a really important video, especially for those that are newer to the market. As well, this is gonna be my last video until we transition to what I want Steady Invest to really be about. We're gonna be looking at individual stocks, ETFs, what I like, what I don't like, and it's going to be a lot of fun. It's going to be a lot of interaction with you guys, and I'm super excited. So if you are new to the channel, please subscribe. We have a lot of content coming out as well. Please like the video. Helps the channel a lot. All right, without further ado, right now, the S&P 500 compared to 5 years ago is 70% higher. That means you have to invest 70% more now than someone who did 5 years ago just to get the same amount of return. And this is an index that goes up 6% a year. So for it to have gone 70% over 5 years, that's substantial. On top of all of this, when we look at the forward PE of the S&P 500, so the current share price divided by its expected earnings, we are trading at levels comparable to the 2000 tech bubble crash. And this is a really big red flag because the higher that PE ratio is, the less and less of a deal that we're getting and the more we're getting ripped off. Think of it like this. Your TV breaks, you go to Best Buy, you have enough money to buy an 80-inch TV, but they say, you know what, with that amount of money, we're only going to give you a 40-inch. That's essentially what the stock market is right now with certain stocks. You're getting absolutely ripped off. Another way to look at it, Apple right now has a bigger market cap than Sweden, Finland, Denmark, Belgium, and Norway combined. Now, if you're just trading a swing trade or a day trade, this means nothing to you, it doesn't matter. But if you're a long-term investor, please be cautious. And it's really hard to not be emotional when you haven't been in the market and then you see a bunch of friends or you see other people making all this money, and you know what, stocks only go up, but that's not true. If you had invested in the peak in 2000, you wouldn't have broken even until 2015. You would have had to live through two crashes, that 2000 crash and the 2008 crash. In 2009, you would be down 70% if you had bought in the previous crash in 2000. How many people do you think actually held through those years? I bet you not very many. Investing isn't, I'm going to invest in Tesla and make 100% over 5 months. That's not the way investing works. Yeah, it's nice if it happens, but investing is a process that takes years and you should have that mentality or you're going to be disappointed. And this isn't just with big tech. There's a lot of companies that are really overvalued. Look at Shopify, look at Zoom. They're great companies. They're priced in for like 5, 6, or 7 years of growth. Like that's not sustainable. I mean, it might be for now until it's not. And that's what supply and demand is at the end of the day. There's demand for those stocks right now, so it's going to go up. On top of that, interest rates are low. People are getting stimulus checks from the government. People are bored at home. They can't go anywhere. So what are they doing? They're like, you know what? What am I going to do with my money? I'm just going to put it in stocks. Stocks only go up, right? And that's true for now as the government keeps putting money into the market as well as demand being high. And this is all good until it's not. Once supply becomes higher than demand, it can get really ugly really fast. I'm not saying that's necessarily going to happen, but it's a huge possibility you have to consider. And what are you going to do if your stocks go down 50, 60, 70%? Are you going to panic? Are you going to sell out? Are you going to buy more? Have a plan. And don't fear a market crash. Market crashes are our friends. They give us stocks when they're on sale. And like we see time and time again, stocks recover. The economy recovers. The market recovers. What the real tragedy is if someone invests their money into really risky stocks, it doesn't go well, and then they can't retire on time, or their life just implodes on them. All right, thank you, Adam. Thank you for telling me that if I didn't invest 5 years ago or during the market crash, that I have no chance at sizable returns. That's not what I'm saying. Let me tell you guys what I'm going to be doing. Firstly, don't buy into hype. Don't just put your money anywhere. People love to chase the wrong thing at the wrong time. And I know this sounds like a little bit of romantic advice, but the same can be said with stocks. When everyone loves a specific stock or a specific commodity or whatever, everyone wants to buy into it. But why are people buying into something when it's already expensive? Because right now, growth is really expensive. Don't get me wrong, I love growth, but I also like a good deal even more. Imagine you bought a house in 2008 after the market collapsed. No one wanted to get into housing. It was just a bad sector to be in. But if you bought in then when everyone hated it, and then once it went up, you would have made a lot of money. And once people saw that the market was going up, people start loving it and they start buying it. And yeah, people that bought houses in the last few years are also going to be making money, but nowhere near as close as those that bought in 2008. So right now, I'm investing my money into stocks that are undervalued, whether it's because the sector's been beaten down, or it's a growth stock that's undervalued, or whatever the case may be. And just because I'm looking at value doesn't mean I'm neglecting growth either. I'm trying to find undervalued growth stocks, especially those with smaller market caps because they have so much room to grow in the future. You also have to understand, like stocks, your decisions right now, today, will compound over time. If you make good financial decisions right now, your life is going to be so much easier. But if you make bad financial decisions right now, you'll have less time and less money to work with down the road. That's all I have for my video, guys. I really hope you take into consideration valuations when you guys are doing your due diligence. Otherwise, thank you very much for watching, guys. Please subscribe, like, and comment. Let me know what you think. Otherwise, I'll see you guys in tomorrow's video.